Welcome to the Thematic Edge podcast. I'm Marvin Barth of Thematic Markets and Seriously Marvin, and I'm here with my good friend and co-host Mark Farrington of the Global Watchtower. Mark, welcome.
Good to see you, Marvin. How's everything?
Fabulous here in London. You may hear some thunder in the background. We've actually got thunderstorms in London today. Um, Now, the last time that we talked, said that we needed to really focus on what was going to happen under the Kevin Warsh Fed, and that's something I'm writing about this week. So hopefully, by the time this gets out, we'll have that published. But I think there's a broader context here, which is what's been going on across central banks around the world, because there has been a very clear pattern across them that I think has set up the second half of the year in a pretty stark contrast with the first half of the year. So why don't we start with that? You uh, as you are manning the watchtower over there,
Yeah.
have a great vantage point on all the central banks around the world. How would you frame the issue as you see it?
Okay. Yeah, of course, I've been much more focused on North Asia than European central banks. But I was watching closely as the central banks got together for the G7 meetings and IMF meetings in March and April, and already, I could see from the tone of the off-the-cuff comments that they were making to the press as they came out of these meetings, that there was this kind of synchronized interpretation of the shock that was being caused by the closure of the Straits of Hormuz. And I was surprised because obviously not every central bank had the same starting point. There was different degrees of inflation problems. They should have all been, modifying their message to to their domestic circumstances, but it was more like this is a shock. It's difficult to process. Historically, it has been wise to sit through external supply shocks, etc. And that immediately began to make me nervous. And I think the round of meetings in April and early May confirmed that concern that the central banks were just going to, in general, skip taking action when I think, even though there was a ceasefire in place, most of us understood that this was far from over by the end of April. And so, I wrote in my Watchtower reports there at the end of April that this was going to be bad, particularly for Japan, who's obviously the furthest behind the curve, and that they would have to intervene in the currency market and that the bond market would punish them. And it did just that. But then, as we saw, energy prices, spike again during May, then we saw the steepener across the world, in all the major markets in particular. So I think that there's a lot of pressure on June meetings for the central banks that decided to take a risky, in my opinion, wait and see attitude in April. Now they really have to make up for lost time. So, we've got this confluence of central bank meetings with, ECB kicking it off, and then the BOJ, Fed, and Bank of England. So, uh, you know, I'm pretty sure we get a rate hike out of BOJ and ECB. Those are sort of fully priced now. But even for the Fed and the Bank of England, we need a hawkish outcome of some kind. We really need to see the tone change. We need to see the way they're dimensioning the problem change. And I think that will then resonate around the world, where you get a number of other central banks which are on the fence, ready for a rate hike at their next meeting to take place. So June's a big month. Central banks need to get back ahead of the curve. They've been lagging, and the market has punished them for that. Not so much just in yield curves, but also in increased volatility, which seen play out in the equity market as well. So that's my quick take on central banks. Time to catch up.
Yeah, so I think that makes perfect sense and it fits well within my framework. I mean, as you know, I think that the critical driver of inflation, certainly in the inflation that we've seen in the last several years has been a shift in inflation expectations that, as consumers expect more inflation, they're more readily willing to accept a price rise from someone. Otherwise, they see it as a negative income shock. Oh, the price of that went up. That means I can buy less of it. So I do buy less of it. That happens if their price expectations are stable. And I think that's why for me, it's been very critical to differentiate consumer price inflation uh, uh, expectations from markets in inflation expectations, so-called break-even rates or inflation swap rates, because markets are forecasting where they think things are going to go.
Right.
Consumers are actually in the pricing decision and they actually affect it.
Mm.
And this is something that I think that, unfortunately, central bankers across the world, you know, in the last 25 years or so, since they've, had more access to things like break evens, have thought, oh, well, these are really good at predicting inflation. And when inflation expectations are stable, they are, right? Markets are really good at pricing in an oil shock or a
Yeah.
food shock or whatever it is.
Right.
But markets aren't really good at figuring out what consumers are thinking, right?
Mm.
That's something they don't do well.
Yeah.
And so, unfortunately, there's been this shift in focus in central banks that they think that, well, we can just focus on what markets tell us.
Right.
And that leads to the setup that you just said. You put it in terms of initial conditions, right? That if your inflation was high, you can't really look through it. And I would argue that it's really about, are your inflation expectations managed or not? And those are obviously correlated. If your inflation expectations are not managed, you're going to have high
Yeah.
inflation, right? And that's actually one of the clear signals to me that inflation expectations have gotten out of control is that you do see higher than target inflation in so many different places. And so all these central bankers, to exactly your point, they were running around talking about this story that, well, in theory, we should be able to look through a supply shock. We should be able to say, well, this is transitory. It's a negative income shock, and we should look through it because consumers are going to pull back consumption as a result of it. But that only happens if you're credible on inflation. If you're not, then the consumers say, well, this is just another inflation shock they're going to look through, and we're going to get more inflation. And, ultimately, my wages, everything is going to go up in an inflationary manner. So this is not really an income shock. And they continue to buy. And that's exactly what's happened. We've seen surprising strength despite the clear actual real income shock from higher fuel prices, and real fuel prices have gone up, right? That has been a negative income shock to people, and yet still people have looked through that and accepted higher prices on everything else. Core
Hmm.
good prices have accelerated, and central banks now face a reckoning. It's much, much more difficult to pull that back. And I think this is, in many ways, far more dangerous than what we faced during COVID, because COVID was an exceptional circumstance, and it was the first time that central banks really screwed up in,
Yeah.
30 plus years. This is the second time in 5 years. This is going to be harder for consumers and I think eventually markets to forgive.
Completely agree with you on that. And I would add to that the market is also looking for this philosophical change at central banks because I think one of the reasons they have been so focused on, will there be any demand destruction is because they have, institutionally evolved to being a central bank that must always protect the downsides on growth
Yeah.
because we just had shock after shock since the global financial crisis where extreme monetary policy was required to prevent interest rates going through the lower bound and these type of asymmetric risks that the central banks felt they were facing. So they were hypersensitive to any miss on the downside and then very tolerant of inflation risk on the upside because they felt that their toolbox was asymmetrically skewed there. So now we're in an environment where we're getting rolling shocks to the upside. Inflation expectations have been trending higher for
Yes.
3 or 4 years. So regardless if you're a central bank targeting 2%, your inflation expectations have been trending in one direction for 3 or 4 years. So the market's trying to understand, are they dogmatic central banks? Is this asymmetry still there? Because nothing in the behavioral pattern suggests that they have adopted to the new world we're in. And so I think the regime change that many people talk about with Warsh, which we can get into, is also, I think, playing out a bit globally. We've been incrementally implementing a regime change in Japan for the last 3 years under Ueda, and we're seeing replacement of other central banks. We have, new Governor Shin at the South Korean Central Bank, and we have a few hawkish central bankers in, Brazil and Norway. There's a trickle in the direction of the change in types of leadership and institutions in central banks. Now the market wants to see that manifest in outcomes at the central bank meetings and in the minutes and in the statements to show that really the way they're articulating the risks is very different now.
Yeah, it's um I was at the Hoover Institute a month ago, as you recall, and their monetary policy conference. And on the sidelines, I was speaking to a former FOMC member. Whom I won't name, but we were talking about, the good old days versus now, and this person's tenure sort of crossed over those, and I recall when I was at the Fed, people talk about the dual mandate that the Federal Reserve has, that it's price stability with full employment. And in those days, we always thought about it as, well, yeah, legally that's what it is, but effectively we have one mandate, which is to get price stability.
Yes.
Because if you don't get price stability, you're going to mess up the other mandate. When
Yeah.
inflation gets out of control, all you're doing is basically letting pressures build up in a way that you're going to have a bigger recession later or something. So really just focus on that one mandate. And that was always, and every single person you would talk to at the Fed felt that way. And I was talking to this former FOMC member. I said, it feels to me like in the last decade or so, the FOMC has really erred on the side of, no, we just need to protect the downside on employment, and that's more important than our inflation mandate, not
Yeah.
recognizing that they are ultimately going to pay a much bigger price on that. And this person said, absolutely. You could see it in the meetings. That was absolutely clear. And so I think you've hit the nail on the head, and you really do need a regime change back to
Yeah.
that view that, look, if you don't get inflation right, you're really going to mess up the employment mandate. There's just no way around it. You're going to have to suffer a bigger disruption later if you keep putting this off. So let's talk about this regime change. I do think that obviously the most important one right now is the Fed,
Yeah.
because we are going to have a change in leadership uh, at a time when you've just described the market, and I would say the economy is desperately screaming for a change in regime. I mean,
Yeah.
what's your read of what people should expect from, or what people do expect from Kevin Warsh, and how this is going to play out?
Okay, well, great. Well, I'm much more interested in hearing your view on how he's going to manage the board dynamics because I think, you're the perfect person to comment on that. But, my intuition is to back him as an extremely successful person, both a successful central banker when he was involved in that part of his life, and then also as a private sector person afterwards, and that he he's going to come in strongly and do his best to turn the aircraft carrier in the first meeting. Now, there's some limitations on what you can do in the first meeting, but I think, you really have to come out and just state it very plainly, all the objectives that you have and how much you need to change, and then make it be visible. So change in the tone of the statement, forcing the dissenters to articulate exactly why they're dissenting in a way that will show up negatively on them in the minutes, should they prove to be wrong. I mean, really just like a glaring spotlight of transparency on the FOMC to force, not to force people into compliance with Kevin Warsh's view, but to force them in compliance with the world view, because I really feel like it is so divorced from the way most of us are viewing the economy and the inflation risks in general, that they really need to be called out and forced to justify this stance. So that's what I'm looking for from the Fed. But I think that it won't be enough just for the Fed. We also need, the Bank of Japan to change its tone and to make it clear that they're actually going to, insist on meeting their inflation target. And the ECB, if they only do 25, they also need to come out and make it clear that, they're still going until inflation is brought under control. Because, as you mentioned, the consumer has remained solid through this. The fears of demand destruction were obviously overblown, and the central banks just really need to tie this inflation risk off. It's not a big challenge. They're making it into a bigger problem by not acting sooner. So, that's my expectation. June is this sense of urgency finally comes back in everyone's actions and statements. And I think Warsh will do that, plus the institutional shakeup message that we're all counting on as well.
Yeah, this is I mean, look, I completely agree with you on that point that they made a sequence of errors here, not being willing to take their medicine and not recognizing that the economy clearly could. So I mean, to me, the big mistake was when they started cutting rates in 2024.
Yeah.
Is you had 2+ years of real rates, and it's real rates that are the sort of important variable for the economy, um, at almost 3%. And the economy was still growing at more than a percentage point above what they think is the economy's speed limit.
Yeah.
This clearly was telling you something that actually, one, your view of what neutral rates are is wrong, and probably your view of what is the speed limit or potential growth of the economy is wrong. So I think that is something that is going to have to be addressed. And the situation that Kevin Warsh walks into, I think, is really difficult. Now, you asked about how he's going to handle the board dynamics. I think that's the critical question here, right? Because if you think about who Kevin Warsh is and how he got to this position, Kevin Warsh has been, and as you know, I had forecast that he would be the choice, and it was precisely because, contrary to all the president's rhetoric about low interest rates and otherwise, if you look at what the um, whole MAGA movement, as well as the president himself, has said, they do have think that the Fed is just too big an influence in the economy. It is taking on decisions that it should not, that are arguably fiscal policy, i.e., things like QE is effectively determining what the maturity structure of the Treasury's debt looks like. Well, that's not a decision for unelected officials. Buying
Yeah.
mortgages, that's not a decision for unelected officials. That's fiscal policy. And so that whole populist view was always, we need to take the size of the Fed down. If you want to marry that with the sort of pro-business Republicans who always want more deregulation, well, the thing that kept the Fed's balance sheet higher, and I've written about this, I won't go into the details here, is really the Basel III regulations that were put in place by the Dodd-Frank Act. Those are what forced the size of the balance sheet. And so if you want to slim down the balance sheet, you actually have to deregulate the bank. So you sort of get both parts of the Republican Party behind that. And who has been the most effective and most consistent spokesperson for a smaller balance sheet? It's the guy who literally resigned from the Fed over its balance sheet expansion in 2011 and has been talking about it ever since.
Yeah.
So that's what Kevin Warsh wants to do. That's what he was chosen to do. And the whole point of that was to get the central bank to focus on its core mandate of inflation stability. And yet he's walking in the door with its mandate completely destroyed by his predecessor in some sense. I'm probably being a little bit harsh there, but not really. I mean, they've done a bad job. And he and so instead of working on the thing that he really wants to work on, he's got to do this, and he's got to do it with the committee that created the problem, including the former chairman.
Yeah, I don't envy him in that sense. So just let's break those or separate those just for
Yeah.
a second. How does he articulate the story that, look, we've got this little short-term inflation spike that we need to address, and given policy lags, we need to be on it now. So let's all agree to cut rates, to hike rates here a bit through the summer, and put that inflation risk to bed, even on a risk management directive, so that we can get to doing all of these structural improvements that I want to do. How does he convince them to do that? To get them to go from what the minutes said they were discussing at the last meeting to a rate hike in one meeting?
Well, I think that's the challenge. And the critical point is he needs those people to do what he really wants to do, but he also needs them to address the inflation problem now. And turning around, walking into the room and saying, "You guys screwed up. Now I got to clean up your mess," probably ain't going to get a lot of votes. But I do think that he's speaking to multiple constituencies here, right? So one, he's got to speak to markets.
Yeah.
And markets, I think, are leery of him, as you were appointed by the president who just keeps saying he wants lower interest rates. So are you really actually interested in changing the regime, or do you want lower interest rates? And he's furthered that himself with his arguments most recently. In general, if you look over the course of his career, he's been very hawkish. He all of a sudden in the last year has been talking about productivity gains bringing down inflation and how that should enable lower interest rates. So he's sort of worsened, I think, markets' concerns about this. And if you look at Fed funds pricing, they really, we don't even have a full interest rate hike priced in before the election, which I
That's
find
incredible to me.
insane given where we are. But then they ramp up. So if you look at 1 year forward rates, those are up significantly relative to this. So markets clearly don't think he has the guts to go in and do this,
But
or
can
the
I just ask
ability
you,
to turn the committee. Please.
do you think that is a political interpretation or an economic interpretation? Saying markets say Warsh doesn't have a green light to hike rates until after the election, so therefore we're not going to price one till then. I mean, is it that? Because the economic discounting makes no sense, but if the political calculus is that, then it's just also an unbelievably risky bet to be just totally betting against any rate hike before the election just because of politics.
Well, look, I mean, the November Fed funds contract has 16 basis points priced in above current rates,
I know. I
right?
just
Like
can't get my
that's
head
just
around it though. What are they imagining?
well. So look, there's two potential answers to that. I lean in the favor of it is that markets just don't think, because when I talk to a lot of market participants, when I talk to my clients, a lot of them say this. They say, "No, there's no way Trump would allow him to do that," right? And let's come back to that point.
Okay.
But this is certainly something that seems to be a big narrative out there. So I lean in the direction of markets just are very suspicious that he is not going to act politically in favor of President Trump, and that they interpret that to mean that he can't raise rates. But there is another one, which is basically the one that you highlighted earlier, which is that central banks have trained markets that they're going to focus on growth over inflation. And so
Mhm.
as a result, if you still think that there's another shoe to drop, you know, everyone, how many months into this are we now? And everyone's still saying, but oil prices are going to go to $200 any moment now.
True, true, true.
And so I do think there's an element of that that's going in there, that it's probably both of those. But the clear point is that he walks into this not only with a hostile committee, but also with this monkey on his own back, that markets don't trust him, that he's not, in Elizabeth Warren's, I think, totally inappropriate words, a sock puppet of President Trump. And that, by the way, to me, I mean, to me, it makes it very clear he has to come out quite hawkishly in this meeting, certainly
Yeah.
personally. And I think it behooves him to, with, and this is the fine line. How do you do this? How do you come in and put the blame on the committee that you just inherited? And in particular, it's outgoing, it's former chairman who's still on the committee,
Yeah.
so that you can signal very clearly to markets that you represent a clear break with that. Because one, that completely removes market skepticism that you are this sock puppet, right?
Yeah.
And two, you and at least I think you would agree with this. If you or I were like dictator of the Fed, we would go in there and do a 50 right away. Like no
Exactly.
question, just bam, and convince markets. And then, by the way, we would go tell the president, guess what? Watch what happens to the 10-year on this,
Yeah.
right?
Yeah.
Because you are actually going to be doing the economy more favors and set up the election win better by
Yeah.
coming out and taking that heavy dose up front and regaining credibility
Yeah.
than you are by trying to delay it.
Yeah.
And so,
Yeah.
a guy who worked for Stan Druckenmiller, I am
Yeah.
sure that somewhere someone has told him this, or he's thought it himself, that that's exactly what he needs to do. So how does he get the committee there, I think, is the critical question, and
Yeah.
not turn them all off.
Yeah, I think, I had been viewing this problem as two fronts. How do you convince the committee that, one and done 50 basis point up front is actually the optimal? Let's not talk about what's possible, but that's optimal. And the other front is then to convince Trump that one and done is optimal. That even though you're raising rates, you're actually lowering, mortgage rates, for example, because the curve
Yes,
is going to flatten, and that's what's going to matter more in September, October, when you're polling for the midterms, etc. So if you can articulate that story, and you're right, I hadn't thought about that. Basent will definitely, echo that sentiment and back up
absolutely.
Warsh. And if you can convince those two audiences, the White House and the FOMC simultaneously, one and done up front, you could even make the case for 50. That's why I cannot understand how you can have zero priced in,
Yeah.
1 week before the meeting. It's insanity, actually.
Well, I mean, I find, look, I get the perhaps nothing, I mean, like literally zero priced in for June. I mean, if you look, June has zero priced in. Not 1 basis point priced in. That is nuts, because there is clearly a chance they will. Um, I do think it's probably unlikely given how you're going to get the committee there. I shouldn't say unlikely. I don't think it's the highest probability outcome. But when you get to July, August, September, if you still don't have at least 25 basis points priced in, there's
Yeah.
something wrong with markets thinking on this. I mean, that is absolutely a clear gimme in terms of, being short those Fed funds futures.
No, I
But
agree. If you're going to say no rate hike in June, you should but then for sure be pricing 50 in July because the
absolutely.
July would have to be the if June is not the catch up for the mistake in April, then July is definitely the catch up for the mistake in June and April. So
It,
like honestly, to have nothing to have June and July priced the same. I mean,
yeah,
that's like
it's
it feels like it's pricing institutional immobility rather than economics, Like I don't understand that.
so then there's the question of how you get there. How do you manage that? And I think the critical issue here is managing the statement. Get the statement first. And you know, recall that one of his big mantras has been that the Fed communicates too much. He says they're talking too much. They shouldn't. Um, they're not good at forecasting. I have this amazing chart in that Hoover speech that I gave that's I published on Seriously Marvin, which just shows their GDP forecasts. The most bullish member of the FOMC has been putting long run growth below the average of GDP for over the last 10 years. It's telling you these guys are not any good at forecasting. So stop.
No error correction in the model.
Nothing. This is all, you almost have to ask, are they even paying attention? Right. But so he said, stop talking about that. Let's communicate a lot less and let's stop putting out numeric targets and things like that, because that's where you really lose your credibility, is when people can measure you against a specific number or something. So, one thing is, I think, and I'll give credit to Vince Reinhardt, who is a former mentor of mine. I saw that he had put this out, and I agreed with much of what he said. He said, "Look, first thing is, Kevin Warsh doesn't actually have to participate. He probably can't change the statement of economic projections right now. He can initiate that discussion that in the future they should get rid of it, but he can't at this first meeting. But you know what he can do? Is he can
Mhm.
just not participate." And Vince
Interesting.
doesn't say this, but I think it goes even further. You tell all the other FOMC members you're not going to, right? See how many of them participate at that point, and then it's basically dead, right? So
Yeah.
SEP is probably dead.
Yeah.
Okay.
Okay.
The statement itself, here's a really interesting point. The chairman has the prerogative to draft the statement. Now they'll argue and they'll edit it back and forth, but this chairman can draft it. And Vince makes a very good point. Why not just stick to the facts? Right? Like, why do you have all this? Oh, well, we're really committed to, our long run goals. Well, of course you are. That's your legal
Yeah.
mandate. Like, throw
Yeah.
out all that, fluff that's in the
Yeah.
statement and just put it in the statements. Now, once you do that, you have a really interesting thing, because if you're just going to put in true, undeniable facts,
Yeah.
how do you vote against that? Right? So you put inflation has been above target for a sustained period.
Yeah.
And we're facing a price shock. The economy is showing significant resilience under sustained shocks. Investment numbers are very strong. You just put just some things like this, and it suggests that the balance of risks is towards inflation.
Yeah.
And then you basically just dare the rest of the committee to vote against it, and
I think that's brilliant.
we'll really get to see who on the committee has been going along to get along with Chairman Powell, which you've seen in my research, has the lowest rate of dissents of any Fed chairman ever. Were
Mhm.
they all just going along to get along, or did they all just really agree with them? Well, we're going to get to see. And you also put the chairman himself on record. And finally, because you've basically said this on your first meeting as FOMC chair, here's what I inherited.
Yeah.
You've made it all about that guy. You've basically kitchen sinked it.
Yeah.
Right? So I think that's the way he handles it. And it's probably a two meeting thing to get to the rate hikes.
Yeah.
But, you know, if you do get that statement around, I can't imagine there's not somebody around the table who says, well, if this is true, why aren't we hiking today? And you say, hey, that's a great idea. Why don't we?
That, I love that actually, and it makes perfect sense because I have grown also very tired of the way central bank statements are written, where they're all aware that they're being read by natural language processing models that look for some change in the grammar or the subject versus the object, etc. Instead of just writing, about the economy and using actually factual definitions of where the economy is at, so that we get out of this over focus on words and tone and look at the hard numbers. So I think we've seen a pattern of a similar pattern both in Japan's. I wouldn't say so much the minutes, but they have something in Japan called the summary of opinions, which is
Mhm.
unnamed accounts of different opinions of all the board members, and then also the speaking schedule, where they've come out and made these very factually uh, reinforced arguments about where we are relative to the neutral rates, where we are versus the potential growth rate and the current status of the output gap, etc. And anybody who would read the speech or read that summary of opinion would naturally conclude that you should be hiking rates. So, this I wrote up in the BOJ Watchtower because we had three dissenters who made it very clear that we had sufficient evidence to raise rates in April. And then we had two additional board members who came out and gave a speech that just made you de facto arrive at that conclusion. So I think that writing the minutes that way is a very powerful thing that Warsh can do. Write the minutes in a way that, like any
The
central
statement, not
banker,
not the statement, not the minutes.
yeah, sorry, the
Yeah.
statement's something that will come out. Right, yeah, write it in a way that you can't really vote against it. The logic is too tight. The logic implies that you must do a risk management rate hike at the least. Um, Whether you can convince them to raise rates based on where they are relative to the equilibrium rate is another story. But you could easily word it in a way to convince them to do a risk management rate hike, which is what I think is the easiest threshold to clear.
So the one question I have around that is that um, this whole generation of central bankers um, has grown into this idea, and Warsh clearly rejects it, right? Warsh has made this very clear. That's the problem with all the communication,
Yeah.
is that actually you're supposed to have markets figure out your reaction function and read the data themselves,
Yes.
right? But he's alone in that view. If you look at the current set of central bankers, not just at the Fed, but across major central banks, they generally all have this view that you need to lead markets to that and you need to guide them there and that you can never surprise markets. And I mean, you just go back to this point that we just said that there's literally 0 points priced in for June. There's a couple of basis points each for July and August. Um, how like is he going to be able to, even if he gets that statement through? And I think he'll get the statement through. It'll be interesting to see if there are dissents on facts. But um, how does he get a bunch of people who seem to have this philosophy that you cannot ever surprise markets to go ahead and hike rates when there's literally nothing priced in?
Yeah, that's also become a problem with forward guidance. I don't know if you saw today, like the BOJ or the Nikkei ran a headline story: the BOJ will raise rates to 1% next week. But official sources say, like the discounting process is so manipulated now. Like
Yeah.
they eliminate all potential for doubt that there's going to actually be an open debate at the meeting. They're like, it has been determined before the meeting even starts. And there's some version of that in all the other countries as well. Japan is the most egregious offender on this level, but even in the US. So it should not be that you need to telecast the outcome of the meeting in advance. The market should, if it is truly driven by risk management models, there has to be some incremental discounting of the probability of a surprise rate hike in June and July. For
Yeah.
it to be zero is very much in that mold. Like it's not going to happen because the institution hasn't told us that it's going to happen yet, rather than saying the economy and the trajectory of prices and the trajectory of this, choke point problem we have in the Middle East implies some sort of linear risk path between now and August. That's what the market should be pricing in, not this step change reaction function that happens, every 5 or 6 weeks in a central bank meeting. I don't know how we get from where we are now to this more fluid discounting of macroeconomic risk rather than policy interpretation of macroeconomic risk. So I hope Warsh can effect that somehow, either through the statement or perhaps the press conference afterwards. I think he will give a press conference after, and he will be asked very pointedly by reporters, what was different? What did you change? What did you find it? Did you receive a lot of pushback, etc.? And I think he might take that moment against his own advice about talking too much once off to say, this is what I tried to do, and it was reasonably well received, or it wasn't well received, but we'll make progress in the next meeting. So I think he will try to make it clear that he's on a mission and he's began that mission, and it's either going to be easy or it's going to be hard. And I think that will be useful feedback for the market if we get that.
Yeah, I think, look, I think he'll ultimately get there. He's going to push them in and force that issue on them through time. The question is whether he can do it this first meeting. And there's another interesting question, which is the extent to which he really cares about the dissents, in the sense that if you recall, one of the other things that he has said consistently over the last several years is that there's too much groupthink at the Fed. And I mean, that's illustrated by that point I just made about, their forecast being just too tightly aligned and not differentiated and not even like really facing reality, as well as Powell having the lowest rate of dissents of any Fed chairman ever, is that they don't actually have real discussions, or at least it's not apparent in any of their actions. And so for him to come in his first meeting have a bunch of dissents is actually an answer to that, you know, um, uh, presumed reporter's question, what's different? Well, we had a discussion, right?
You bring up a very good point there because I think it is not yet clear whether the reason that we don't have enough diversity of an idea on the FOMC is institutional and atmospheric driven, or is it personnel driven?
Yeah.
Because if it is personnel driven, then we need a purge. Warsh is not going to be able to achieve his goals, and neither will the Trump administration without a purge. So I think it'll be a very good test whether it's atmospheric, a much more open, inclusive environment for everyone's diverse opinions, or whether it's actually personnel.
Well, I think that purge becomes a lot easier if you call everyone out, right? So that's what I love about the sort of fact-based statement. Look, we're not in a good place and we're going to make changes.
Yeah.
And because you put everyone on record, do you want to defend what you've done for the last 5 years,
Yeah.
or do you want to move in a different direction? That is basically what that statement would do. And then once you have that, it does become much more clear that there is a partisanship there, perhaps, whether
Mm.
it's, Republican versus Democrat or just, you know, uh, elite versus populist, whatever. There is some sort of partisanship there that the American people need to deal with. And I think there's a big political message that comes out of that. So in many ways, what you could see is for all those people who think Trump's going to be furious with this. I think one, like it is critical that Bessent is Secretary of the Treasury and that he seems to have been the one cabinet member who has consistently been able to have an effect on the president. And for
True.
him to be able to go in and say, look, Mr. President, we're not going to get around this. We're going to need to hike rates. And it's better to get this out of the way early,
Yeah.
and it's going to start to help mortgages and long end treasury yields. If we do it appropriately, that's a really important thing. So if that message goes through, I think Trump will be supportive of it. The other thing is that this is to the extent that he, especially like the dream scenario, I think for them is to have Powell vote against it, right?
Yeah.
Then it is literally drawing a line and saying all these inflation problems were these guys. I'm
Yeah.
the guy coming in solving the inflation, which is really what his voters care about. So I think it's a big win politically for him to actually do that. And in many ways, that is doing the president's bidding, whether people think it is or not.
Yeah. No, it's a good call, actually. If the people who dissent against Warsh's statement are the same people that are on a short list to be replaced by President Trump, then he will say, yeah, you called him out. Well done.
Yes, exactly. And by the way, that's where you get to these issues of, well, in the longer run, how do you force these people off? Well, one is kind of by embarrassing them and making it clear that they are the problem, right? Sooner or later, those people are actually going to drop off by themselves. And, you know, um, after that, like, the chairman can play hardball. One of the things that the chairman has a tremendous amount of power over the institution. So he's only one of the 7 votes on the board and only one of 12 votes on the FOMC. And within those committees, he has the power of the pen to draft the statement. So there are some important things. But in the background, he has a lot more power. He manages the board of governors, right? So he has control over the staff. He has, by the way, the right to hire and fire the staff. Hire is different. Senior roles still need to be approved by the board, but he can get rid of anybody on the staff he doesn't want. So he can reshape that. He also can control the access, the flow of information. So, now in my old days, there was none of this. Everything went through the chairman, through Chairman Greenspan. Chairman Greenspan used this power very effectively.
Who got the corner office? Who didn't get the corner office?
Well, oh, there's that one, by the way, too.
Yeah.
So the chairman also gets to choose which board members and which presidents are on which committees and all of those sorts of things. That actually is in his prerogative and corner offices. But there's also just literally access to the staff. So he could really shut down access to the staff. He could also reshape the staff in a way that the forecasts that are coming out to them
Yeah.
are very different. And if you look at the statement of economic projections and you basically do a regression of that on the staff forecasts, well, guess
Mhm.
what? They look exactly alike.
And what about the speaking schedule? Is he able to determine who on the board or FOMC is allowed to give public appearances?
Um, I, I think he has more leeway. I don't know. That's a question I'd have to look at. He probably has a fair amount of leeway over the governors. I'm not sure if he has the same amount over the presidents, right?
Yeah, because that's
Um,
definitely been a tactic used in the Bank of Japan, like the rolling out the board members, which will help, build the view that they want to produce at the next meeting. They've managed that speaking schedule very strictly and effectively, I would say. So it's another
Yeah,
op
that's something I definitely need to look into. The other thing, and this gets quite interesting when you start thinking about the investigations into Chairman Powell
Yeah,
and into Governor Cook, is that you know the chairman has the authority to basically dictate what information the Federal Reserve will provide to outside investigations.
yeah.
So, Jerome Powell chose not to cooperate with investigations because he said, no, this is ridiculous political. The new chairman could make a different discussion. That could make life very difficult for people on the board. The chairman also has full authority to launch investigations internally. So
Mm,
if there's credible allegations of something,
mm,
the chairman can launch an investigation. Can't take action, can't do anything about this, but you can make people's lives very difficult. So
mm,
I I think I'm not advocating any of this, obviously, but
mm,
I'm just saying there is um, a huge amount of power that the chairman has to start making life really good or really bad for various, um, particularly governors. And if you have also just called those people out very clearly, I
mhm.
think you could see some significant changes in the committee, and it's all voluntary at that point because you're just making it clear there's a transition here. We need to get things done differently. And to your earlier point in the podcast, a sense that there's a regime change. You actually need to change the governing philosophy of the institution to refocus itself on its core mandate, which is inflation.
What will be amazing is if Warsh can deliver enough anecdotes to suggest that the regime change is, gaining traction and really moving after one meeting. If the markets then rally and validate it,
Yeah,
you because, at the moment it's hypothetical. And I think a lot of people would even push back against it, saying, oh, it'll look like, indirect influence on the Fed, etc. But no, if he makes these moves that we're discussing and he does it in a kind of, diplomatic, nuanced, but correct and definitive way, and then the markets rally and validate that outcome, it sets him up to be even more aggressive in the July meeting and in the August meeting because
yeah.
now he's got the market and the narrative as a tailwind. I don't know how much time we have left, but if you have time, what could you explain a little bit about the role the advisors play? Everyone has commented about Warsh appointing two external advisors. Are the advisors confined to advising the chairman on his policy outlook or institutional change, or are they resources that are available to all the governors? How does that work?
So this goes back to that access to the staff issue. So I don't know about these external advisors. That's something new that you haven't had in the past. The uh, as I mentioned in the old Greenspan Fed,
Yeah.
there were you didn't have staff assigned to any governor or the
Mm.
chairman, just basically the staff worked for the chairman.
Right.
Um, then I can't remember whether this started under Bernanke or Yellen, but you started to get more like at the Bank of England. The Bank of England, each MPC member has a Bank of England staff member assigned to them who basically works for them. The same
Mm.
thing has been taken up at the Fed. You have these advisors that each usually a senior seasoned staff person that the governors have helping them with doing their own research, working with the staff, things like that. A lot more direct staff contact. So that's the type of thing that the chairman is going to be able to control. What I think is more potentially interesting is a lot of the bigger changes that the uh, chairman is going to want to make in terms of changing the way operations are done and regulatory structures and things like that to get to that point of slimming down the balance sheet. The typical way you get that done in any bureaucracy, but especially the Fed, is you appoint a committee that's going to look at it. Now, at the Fed, that would almost always, I can't think of a single example outside where they have had the committee was anything other than Fed people on this committee. They do have, there's these regular outside the bond market association and TBAC. That's a treasury panel, but the Fed participates in it, where you do have outside people talking about things and advising them on things, but not on a specific project, like how would we restructure Reserve Bank operations or something like that. That would all be done internally. But
Right.
if you are really concerned that the Fed has grown far too insular and is not really sort of thinking outside the box, or is too much focused on groupthink, then this would be an interesting area where does he start to have collaborative committees of external experts and internal experts? And I could imagine that would be very effective, and that's probably the direction he's going to go in.
And it sounds a little bit to me like that might be stepping on the toes of the New York Fed, particularly when we get into some of the plumbing issues and the market operation issues. So, of course, New York Fed president has a vote on the FOMC, but how about operationally? How much
Yeah.
institutional resistance do you get from the institution of the New York Fed?
Well, okay, so I'm going to make this short because we should close this up. We're coming in on an hour right now, but I would say one, look, the current president of the New York Fed, John Williams, who I used to work with at the board many years ago, um, uh, famously, um, uh, proudly told everybody he doesn't have a Bloomberg terminal on his desk. That's fine. You're a chief executive of a major bank. People should come in. But the fact that he proudly tells you something about his sort of attitude towards markets. And for those people who don't understand or don't know this, the Federal Reserve Bank of New York is different from all the other Federal Reserve banks. It is the market operations center for the entire Federal Reserve. So to have your president, the guy who's supposed to report to the rest of the FOMC on markets and be the acknowledged market expert, say, "Yeah, I would never have a Bloomberg on my desk." Um, this says a lot, and
Yeah,
I think in my retrospection, looking at the people on the New York Fed desk and the way operations are conducted now, there has been a tremendous loss of skill um, over, I would say, the last 2 decades, but
yeah,
certainly under John Williams' tenure. That even if they wanted to go back to more dynamic operations like they used to on a smaller balance sheet Fed, they
yeah.
frankly don't have the staff who know how to do it today. And so
Mm,
that's going to take a rebuilding operation. Now, the good news on that front
yeah.
is that John Williams faces mandatory retirement next year, so you don't have to worry about him.
I can see you celebrating already. All right,
So
that's
I definitely think that yes, there's going to be a lot of stepping on the toes of the New York Fed. This is going to be a primary source of friction, and he doesn't care because that guy's going to be out of there.
yeah, but he's just one man. I was thinking institutionally, Warsh could also have some vision of how to restructure operations, bringing some to Washington and or be involved in appointing staff in New York. But somehow, the New York Fed needs to go through a bit of a regime change at the same
Oh,
time
I,
as the board.
I agree. And I think, remember that the chair is going to have a big influence on who is. John Williams is president of the New York Fed because Powell put him there,
Okay.
period. Full
Okay.
stop.
Yeah.
Um, Powell wanted to have him as his vice chair. Donald
Yeah.
Trump didn't like him.
Yeah.
Credit to Donald Trump on that one, and said no. So Powell installed him at the New York Fed,
Okay.
and we're paying the prices for that. So
All right. Well, we're
that
cheering for.
there is going to be a big change at the New York Fed, and it needs a lot of change, a lot of change.
Okay. Thanks
So
for that. That's an awesome update. Thanks for that, Marvin.
let's call it quits for here. Thank you again for joining me, and we will get back to this in 2 weeks. And everybody else, tune in 2 weeks. Make sure that you subscribe if you haven't already, and subscribe to the Global Watchtower with Mark and Thematic Markets for me to get our written updates. And we'll see you again in 2 weeks.
Okay. Thanks, Marvin. See you.